Welcome to this video. Today we need to talk about SMCI. Supermicro is now trading at only $30. And in this deep dive stock analysis video, we're going to find out whether this is the last opportunity to buy SMCI. So we're going to go over the fundamentals, the latest news, the technicals, and we're going to find out whether this is a great opportunity for long-term investors. So without further ado, let's dive right in. We're now looking here on the charts on TradingView. We can see SMCI is trading at $30.86. And what's interesting is that in the last 3 months, it didn't really move much. So it's been around the $30 mark for a long time. So the question is, could this be the last opportunity to buy at a low price? Well, my average cost price is around $38. So I'm roughly down 19%, but I'm very long term. So I will hold this for at least 5 years. And I'm very bullish on this company. If we look here on weekly candles, we can also see that it's pretty oversold. And this looks like a great buying opportunity. So at the end of the video, we'll come back to the chart and I will make my final prediction. We are currently in an expanding AI boom, and SMCI is positioned well as an AI infrastructure player. And they're expanding now to telecom companies. So here we can read here, Supermicro expands support for AI RAN and sovereign AI solutions to deliver high performance, efficient and scalable AI infrastructure. So what does it mean? Well, AI RAN basically means radio access network. So they're working together with telecom companies and they're going to use AI to get better connections. So they train big AI models to make their network more efficient, and that's why they need SMCI, and they deliver like a full package to these companies. So they're expanding to telecom companies, they're working together, and that's great for the company. So the company is booming, and I think this is just the beginning phase, and they can do really well over time, and they can really profit from the expanding AI boom currently in this year. So we're now looking here on Guru Focus to get a quick financial overview of the company, and they gave it a score 83 out of 100, which is pretty high. So this is a high growth AI company, but this company is actually very profitable, which is interesting to see. So the financial strength is 6 out of 10, which shows that they don't have too much debt, and the profitability rank is an 8 out of 10. They have net income every quarter, which is great. And here we can see like the latest income statement. We can see that the revenue has been increasing exponentially, as well as the net income has also gone up. And we can see that the cash and debt are well in balance, and the debt is not too much compared to the cash, which is always great. So this company is relatively safe when we look at the financials compared to many other AI companies, because this company has already proved itself and it's already making money, which is very important for long-term investors. One of the most important things when we invest in a company is to know whether it's undervalued, whether you have a margin of safety. And in order to know whether SMCI is undervalued, we are going to use Warren Buffett's owner earnings strategy. And he used it like in his annual report in 1986. So this is a method detailed by Warren Buffett, and he stated that the value of a company is simply the total of the net cash flows, the owner earnings, expected to occur over the life of the business minus any reinvestments of earnings. So what does this mean? Well, the owner earnings is basically the money that's left for the stockholders, and we discounted all future cash flow to present value with a discount rate, and then we can get the total value, intrinsic value of the company, and we can divide it by the amount of shares, and we can get the intrinsic value per share. And we can use this to kind of see whether there's a big difference between the stock price and the intrinsic value to know whether there's a margin of safety. So let's get started. So in this calculator, we can find out the true value per share. Well, in order to do that, we need to fill in all the numbers. And these numbers you can all find in TradingView, and you need to nominate everything in billions. And I filled in all the numbers, but we still need to do the growth rate. So how much is this company going to grow when it comes to the earnings in the next 5 years? And we can find these numbers here, for example, on Finviz, and we can see that these analysts expect it to grow with 16.7%. But if we look here on Seeking Alpha, you can see it's much higher at 29.87%. So a conservative measure for our calculation, we can just put in here 15%. I think that's pretty reasonable. I think they can grow even much faster, but let's just say 15%. We're going to use a discount rate of 8% because money today is more valuable than money in the future. So we have to discount all future cash flow. That's why we use a discount rate of 8%, because this is a high growth tech stock that's in the AI infrastructure market. So let's find out. Well, we can press here calculate intrinsic value, and based on these numbers, we can see that SMCI is undervalued by 49%, so almost 50%. So the potential upside of 96.79% and a true value per share of $60. So based on this calculator, based on Warren Buffett owner earnings, it's pretty undervalued right now, and there is a margin of safety. Are you ready to master stock analysis yourself? Well, I built a step-by-step video guide. So if you want to stop guessing and start winning, then make sure to check the link in the description below. So a great company always goes up in value over time, but it doesn't go in a linear way. It goes in cycles. So there is like optimism, pessimism, pessimism, and we always want to buy when it's below the true value per share. So let's say right now, based on our calculations, it's roughly around $60 now, but the stock price is the yellow line, is only $30. What does this mean? Well, it means that there is a margin of safety. Future can sometimes be unpredictable, but at least we did our due diligence and we know that we're buying a company for less money than its true value. And that's very important. Another edge that SMCI has is that it has an economic mode. So what is an economic mode? Well, an economic mode is the competitive advantage belonging to a particular business that protects its profit margins from competitors in the market and other external threats. So this is a theory popularized by Warren Buffett himself. And an economic mode consists basically of network effects, switching costs, economies of scales, and intangible assets. In order to find the economic mode of SMCI, I made an economic mode analyzer. So you can type in here, for example, SMCI. And we can analyze it and we can see that it has a narrow mode. So it doesn't have a wide mode yet, but it's still pretty good. Like it's an overall mode score of a 6 out of 10. So what does this mean? Supermicro has hardware design expertise and growing demand in AI infrastructure, but lacks strong brand power, lock-in effects, and faces many competitors in the server and component market. But still, their cost advantages are pretty good, and their intangible asset, efficient scale, and switching costs are also pretty decent. So here are the strengths, like strong position in AI server market, agile and quick to market with new technologies, customization capabilities for enterprise clients, and they're expanding rapidly right now. But there's also risk, especially the competition from large players like Dell, HP, and Lenovo. As bullish as I am on SMCI, it's always important to diversify. So this is like a portfolio example of a great portfolio that does well over time. And I would only allocate roughly 7% to the portfolio to SMCI. So I risk 7%, and the upside is still unlimited, but even if SMCI goes to zero, which is very unlikely, then I can only lose 7%. So portfolio management is very important, and that's what I always talk about. I think that's very important. Also cash reserve, so you can always buy low and sell high. And my biggest position is still the S&P 500. We're now here back on the charts, and I'll have to say I'm very bullish on this company. At a market cap of only like $19 billion, $18 billion, I think this company has a lot of potential and a lot of way to go up. And we calculated that the true value is roughly around $60. So I can think that in this year we can easily go to $60 or beyond. Of course, it's not a guarantee. You always need to do your own due diligence. There's, of course, the economic mode is not a wide mode, it's a narrow mode. So there are some risks, there are competitors. But I think by allocating like 7% to this company, I think that gives you a positive expectancy. And I think that this company can do well over time. With that being said, always do your own research, do your own due diligence. But if you like this kind of content, feel free to like and subscribe for more videos. And I'll see you in the next video. If you want to learn how to master stock analysis like a pro and find winning stocks and beat the market so you can build a portfolio that consistently wins, then feel free to check the link in the description down below.